Hello, friends. Welcome to the Weekend Investing Stock Market Weekly Review for the week ending 1st of February. And what a blockbuster uh, consumption-oriented budget the FM has presented. I think all corners of the market were worried about tax hikes, capital gains going up, the duration of long term going from 1 to 2 years. All those rumors were floating around, and the complete opposite happened. Taxes for a large um, section of them were untouched in terms of the rates, and for the lower and middle class, the taxes have been rationalized quite a bit. In fact, for the new regime, even up to higher income tax pays, they also benefit by a smaller amount. So net, the fiscal discipline has been maintained. A lot of consumption has been opened up. Some estimates are saying almost 3 lakh crores of money will be in the hands of the people additionally due to these changes. I'm not very sure if that is the accurate number, but it won't be too off, it seems. So 3 lakh crores is a huge number in any year to be allocated to general consumption. And I think this reaction that we saw yesterday in the markets was a mix of positive reaction towards the budget and a negative reaction for the impending global market scene starting Monday. President Trump has initiated the tariffs on Mexico, Canada, and China on Saturday. And it is likely that the world markets are going to, be in some kind of a shock, and some turmoil will be there in the markets due to this. So I think given that background, uh, if that was not there, I think we would have seen at least 3-4% rise in the stock markets yesterday. But that didn't happen. I'm hoping that this counterbalance will continue on Monday, and most likely we will not get badly hit because of external reasons. This week, from our research desk, we had all these wonderful stories. Are we looking at a volatile phase ahead? How big managers make mistakes? How to not have any bias against any stock or in any sector? Uh, how's the Buffett indicator doing? We got 4 months red close in the markets. What is the history on that? The power of the mother market US, the concentration risk and its extremity being seen in certain markets, momentum beating all factors. So another study on that. Investors are their own enemy when it comes to their behavior, and consistency in some markets being highlighted there. So a lot of content, knowledge is available for you to absorb, and these are sent through different formats. You can go through the blog, you can get the newsletter, you can go to our app, you can uh, see some of these on YouTube. So a lot of platforms are available. Disclaimer, of course, as you're seeing this video, do read it fully. And if you haven't so far, please subscribe to the channel. Now take a look at the daily market chart on Nifty. We have very quickly in 4 or 5 sessions come off from 22,800 and posted about a 600 point, 700 point gain. Um, very importantly, we've also closed above this major candle. Uh, Whenever you will find that the market comes back and closes above a major down candle, that is a good sign that the market has recovered from that level at which where many people are stuck. So whenever you will find that prices go up beyond that resistance point, then that is signaling that the weakness is getting lesser. It does not mean that we will go from here to here uh, immediately. Maybe we will have another leg down, but the strength of the move down seems to be weakening right now. Of course, we need to, the first sort of goalpost is to come above 200-day moving average, which is at 24,000. So I think that is going to be a tough one immediately. But yes, I mean, even if we hover around here in the month of February, I think that is good, and then we can build back up. So my sense is that in the next quarter, there may be a start of the next sort of leg like this up. Uh, and hopefully if the numbers continue to also, the consumption, new consumption numbers that are going to now come in with a lag in the economy, how they are going to percolate in the economy and all that. Stocks, of course, will fly much ahead, and like yesterday itself, you saw many of the consumption stocks already leading. So that leading nature will always happen. So maybe in the next 1 month you will find all these stocks are already 20% up, and the consumption will come maybe 2 quarters later. So 1.69% for Nifty this week is welcome. The chart on the weekly is showing one very important point, that this breakdown point of November second week, this has been recovered. This bottom here, this has been recovered, and this is very important. Although if here also you can say that the bottom was recovered, but then it fell again. That chance is always there. But for now, I think it's a great place to be at. There's a bullish engulfing that has happened last week. So the currently the chart is showing Saturday as a separate entity, but ultimately it will be combined here. Um, on the S&P 500, there's 1% negative for this week, but the S&P 500 remains very, very strong. We are hardly a stone's throw from 52-week high, or all-time high, in fact. Gold is going amazing. We are now at 82,000 plus for 10 grams of gold in India. And just see where we have come from. I mean, 1 year back, this is January end, right? We were at 56,800 and we are now at 82,000. So uh, a lot of folks who don't invest in gold, who think, the Buffett commentary about gold is that gold is a pet rock, it is useless. I think we've shown enough data that not everything that Mr. Buffett may say may be right. So see the data, understand the data, and act accordingly. Don't believe anybody. That is the sort of underlying theme I always believe in. Let the numbers talk to you. If the numbers are telling you that there's an asset class that is delivering 12% CAGR, your equity portfolio market index is also delivering 12% CAGR, and they have a very good hedge. There are the correlation between the two is almost inverse. It is a like a no-brainer to have this in your portfolio. But I mean, you have to convince yourself on that. Dollar index is the big worry. Dollar index came back from this leg up, came down, took support, and actually has gone up again from here. This is not a good sign for Indian rupee and emerging markets in general. So the FII selling may just continue, maybe, and the dollar index remains strong. And President Trump is coming out with orders every half an hour. I don't know. He's working overtime, and he's now on Saturday also given a warning to BRICS nation that how dare you think of a new currency. So all that turmoil is currently on. I don't know how it will end, but there is going to be some give and take on this. Last 1 week, Nifty 1.69% up, Nifty Next 50 1.6% up, Nifty 500 1.2% up. Mid caps and small caps really did not perform in the last 1 week, 0.3% and negative 0.3% on small caps. In the month gone by now, we are still in the negative, 10.9% on small caps, 6.95 on Nifty Next 50. Nifty has been stable in the last 1 month. For the year gone by, we are still in green very nicely. Small caps 6%, Nifty 8%, 500 9%, mid caps 11%, and Nifty Next 50 is at 14%. Nifty Next 50 is that very sweet spot in the large cap space that is performing better than small caps, better than mid caps, and of course better than top large caps. So it's an amazing space to be at. It's a high beta space. So the cuts are also sharp when they happen. If you look back on the last 3 years, we've had 10% CAGR on Nifty, which is below the long-term average. So from that perspective itself, you can say that Nifty is not in a territory that is worrisome, because you can't be at 10% CAGR and be worried that we've gone up too much. Yes, mid-cap space is slightly in above the historical average, which is maybe 15-16%. Uh, or small caps or almost there, maybe 16, 15, 16, 17% here as well. So this the Nifty space is certainly not overbought or anything like that. Over a 5-year period, Nifty is at 14.98, and small caps are at 25.79%. So here is where, the initial 2001 rallies, they have contributed to a lot to these numbers. And overall, over a 5-year period, yes, we are slightly above average on that front. But I mean, given that in the last 1 year we have done very, very nominally, I think we are not too far from a place where, the demand and supply in the market will match and you'll find a floor in the market. In the sectoral overview, uh, this week we had real estate do 11.6%. That's a remarkable comeback. Uh, Consumption stocks 5.4%. I'm sure next week there'll be more on this. Autos up 5%. So Maruti and all these others, TVS Motor, etc. stocks are flying on the budget day also. FMCG is making a comeback, 4.2%. Tourism is up 4.3%. Capital market stocks were down. So, CDSL or CAMS and all these stocks, Nuvama, these stocks have taken a pause. But I think if markets are consolidating and can revive, these stocks also can revive. IT stocks down 3.4% and pharma also down 2.5% this week. Let's also take a look at the last month. So in the last month, capital market stocks are the worst hit at 14.9%. Media, pharma, real estate, despite the current week's gain, overall for a month down 8.5%. These are the worst hit stocks. So if you're looking for bottom picking, look at stocks here. If you're looking for momentum, don't look at stocks here because these stocks are down. Uh, in terms of FMCG and auto being in the green, that's marginal, and basically nothing really is flying as of now, but that can change in times to come. Uh, Sectoral momentum overview for the sectors based on different frequencies of measurement: week, month, 3 month, 6 month, 1 year. You can see that the consumption stocks are leading on the top as an average. Autos are also right up there. Tourism, financial services, FMCG. These are the sectors which are consistently, on average, leading. And you have public sector enterprise, oil and gas, metals, PSU banks that are consistently not leading. Energy, media, not leading at all. Uh, in the very, very short term, in the last 1 week, for instance, real estate had come back very strongly. And IT has dipped very badly in the very, very short term, if one were to take some inference out of this. Is the trend improving or declining? So we look at 50-day moving average and 200-day moving average of CNX 500 stocks. How many of them are above 200 DMA, let's say? So you can see that the trend is changing. We were at 17% end of January, sorry, 28th of January, and we are now at 33%. So a good recovery in terms of number of stocks above 200 DMA is happening on CNX 500 stocks, but still low. I think 33% out of 33% stocks of 500 is barely 160, 165. So a lot of stocks are still under 200 DMA. So the worry is still there whether we will be able to pull back up or not. Similarly, for SMA 50-day moving average is very poor, 16%. Um, while some stocks may be above 200 DMA, but they are still sort of in the short term dropping. That will that is getting shown in the 50-day moving average. In the trend check on the indices, you can see that uh, let's take 200 DMA. So Nifty has 40% stocks which are above 200 DMA, which is not really great news. I mean, 60% stocks are below 200 DMA. And even in other segments, you have 35, 33, 30, 26%. I mean, Nifty's next 50 is the poorest in terms of the trend right now. Only 26% stocks are above the 200 DMA. In the indices space, when we look at trends, so let's look at maybe very short term trends. You can see FMCG is pulling up 60% here. Consumer durables, IT, manufacturing, financial services, these are leading. You can see energy, public sector enterprise, oil and gas, PSU banks are very poor. When we look at, let's say, longer term 200-day moving average, IT is still maintaining it. So IT stocks are medium to long term long, but right now in the very short term dropping. Pharma also in the same space, private banks also here. So look for stocks that are above 200 DMA and also above 50 or 20 DMA. That will tell you that the long-term average is also long and the short-term average is also long. And when these two combine, that is the right way of sort of picking stocks if you're doing discretionary picks. Uh, Other things that can also be done basis this is look for long-term moving averages going up and short-term averages moving down, but still remaining above the 200 DMA. That may give you, low risk uh, entry points in terms of you know having lower stop losses on that. So just some ideas how to trade basis all this. So where is the strength in the market? We look at golden cross, so 50-day moving average above 200 DMA. 39% stocks are in that space. 61% are in the death cross. This is not a good number. This should be the reverse, actually, minimum. Uh, on brutal strength indication, which is price is greater than 25-day moving average, is greater than 50-day moving average, is greater than 200-day moving average. We have only 4% of stocks that are satisfying this condition, and 38% are extremely weak in terms of brutal weakness. Um, in the sectoral strength, you can see for this indicator, communications, health services, process, but these numbers are also very, very small. So, it's better if you have much larger numbers there. So brutal strength, there's not many sectors here. Weakness, you can see in a lot of these industries, a lot of weakness is there. So, just be very careful in terms of what you are holding and what you're picking stocks. Golden cross, again, health services, technology, health technology, and these are groupings from the NSE sectoral indices. You can see this on nseindices.com. And and then golden cross down is again very, very heavy on energy, transportation, utilities, etc. So be very careful with stocks in this space. Even finance is up 68% stocks in death cross in finance. Um, this, of course, these are extremely risky places to be at right now. In the FII DII stats, FII continue to sell, although on 31st they did sell lesser. Uh, there's been only one day in the entire month where FII is bought. And if I look at DII, the domestic institutions, there has been no day where they did not buy. So they have been buying on almost on a daily basis. Cumulatively, however, FIIs have sold 92,000 crores in the last 1 month, and domestic institutions have bought 91,000 crores. So pretty much the institutional buying and selling is a mirror image of each other. So that's all I have for today's yeah, weekly update. Do let us know how you like this content. Do subscribe to the channel and do share this video with your friends and family and on your investor groups. And I'll see you in the next week. Thanks. Bye.